Hi all, welcome to this session. In this today's session, we are going to discuss the difference between the IFRS and US GAAP in terms of revenue, liabilities and financial reporting differences. With related to conceptual and accounts asset related differences, we already discussed in the previous discussion. So today we are focusing on the key differences in revenue recognition, liabilities recognition and key financial reporting differences. So the key focus of today's discussion is revenue recognition, lease accounting, liabilities and contingencies, and financial statement presentation. These two frameworks are more aligned in recent years due to convergence effect. Several important differences remain. Understanding this difference is help financial professionals analyze the financial statement and prepare under different reporting framework. The key learning objectives of today's discussion is explain the revenue recognition frameworks under IFRS and US GAAP. Identify the similarities and differences in lease accounting. Understand how contingent liabilities and provisions are recognized in IFRS or US GAAP. Compare financial statement presentation requirement. And also applies the differences to CMA exam style question, how you can apply these differences in CMA USA style questions. So let's move into discussion. The first thing is revenue recognition. Historically, IFRS and US GAAP have different approach in revenue recognition. However, both framework now follow the similar model used on 5-step process. So now for the revenue recognition, both framework follow the same approach, that is 5-step process. The 5-step process, the first step is identify the contract with the customer. What is the contract requirement with the customer? And identify the performance obligation within the contract. In the contract, there should be a performance obligation. Identifying that performance obligation is very important. Then determine the transaction price. What is the agreed transaction price between the customer on this contract? And allocate the transaction price to performance obligation. Once the performance obligation is completed, you have to allocate that performance obligation, that transaction price to performance obligation. Then revenue recognized when the obligation is satisfied. Once the performance obligation is satisfied, based on that you can recognize the revenue. So this is the commonly used 5-step revenue recognition model which is agreed on IFRS and the US GAAP. Revenue is recognized when control of goods or service is transferred to customer. Once you transfer the complete control of your goods or service to customers, on that case the revenue, on that stage the revenue is recognizing. For an example, a company sells equipment for $10,000 with installation service values $2,000. In this case, the total contract price is $12,000. The company must allocate the transaction price into two performance obligations. In this situation, there is two performance obligations. First obligation is equipment delivery and the second service obligation is installation service. Once you deliver the equipment, you can recognize this revenue 10,000. Once you install the installation is completed, you can recognize the 2,000 revenue. So this is how the revenue recognition work in this case. So that means that there should be a performance obligation or different performance obligation in a contract. Once the performance obligation is complete, you have to link that performance obligation with the agreed price or the contract value, and once that performance obligation is completed, you can recognize that as revenue. So in this case, if you sell the equipment, you can recognize 10,000, and once you install that equipment, you can recognize 2,000. This is how it should work. Then let's move into lease accounting. Now, both IFRS and US GAAP now require most lease to be appear on the balance sheet, improving the transparency. In the initial phase, some of the lease may not be appear in the balance sheet or it is considering as an operating lease. But now it is in the most leases, it should be appear in the balance sheet in both cases, like on IFRS and US GAAP. This is to improve the transparency in financial reporting. However, there are small differences exist in lease accounting model between IFRS and US GAAP. The key differences are the accounting model. In IFRS, it is a single model lease accounting, that is mostly recognize only the financial leases. But in US GAAP, it is two model which allowing two types of leases, whether it is including financing and operating leases. The lease classification, IFRS normally recognize all leases as finance lease, but in US GAAP, it is recognizing finance and operating lease based on the situation. Then the balance sheet treatment. In the balance sheet, IFRS normally considered as a right to use asset and lease liabilities. In US GAAP also it is as similar treatment. Under IFRS, all leases are treated similarly to financing lease. Under US GAAP, leases are classified as operating lease and financing lease. Although both are recognized on balance sheet, expense recognition differ slightly. Both are recognized in the balance sheet. Expense recognition differs slightly in IFRS and US GAAP. For example, a company signed a 5-year equipment lease with another company or a service provider. Both framework recognize right to use of asset and lease liability. However, under US GAAP, the expenses pattern may differ depending on lease classification. Normal case, if the company sign a long-term contract with some other service provider, it recognizes in the balance sheet in the asset side the right of use asset, and in the liability side it is lease liabilities. Both are recognizing in both IFRS and US GAAP. Then let's move into liability recognition. Both the framework recognize liability when a present obligation exists and future economic outcomes are probable. However, terminology and probability are threshold difference. The key differences between IFRS and US GAAPs are probability threshold, more likely than not, probably higher threshold. Measurement, best estimate in IFRS, and in US GAAP, it's often minimum value. Under IFRS, and provisions are recognized when the obligations is most likely than not occur. US GAAP generally acquires a higher level of probability before recognition. So this is a key difference between IFRS and US GAAP. In IFRS, it is required less probability than US GAAP, but when it's compared to US GAAP require more probability to recognize a liability than IFRS. Just look into this example. A company faces a lawsuit with estimated losses. Probable range is 1 million to 3 million. In IFRS, it will record best estimate. Example may be 2 million. But in GAAP, US GAAP, it record minimum amount. If no better estimate. If there is no better estimate, it record minimum amount, minimum expected loss as recognition. It will recognize minimum expected amount only in US GAAP. Then contingent liabilities. A contingent liability is a probable obligation arising from past event whose outcome depending on future event. A contingent liability means suppose a lawsuit or there is a court case is ongoing. In this case, there is a probable loss or contingent liability can occur in the future. That type of loss or probability what we called as contingent liabilities. So there is a slight difference between IFRS and US GAAP between this contingent liability treatment. The probable loss recognize provision in IFRS, recognize liabilities in US GAAP. In the possible loss, both IFRS and US GAAP, it is just a disclosure only. The remote loss, IFRS there is no disclosure, and in US GAAP also there is usually no disclosure. The main difference lies how the amount is estimated and recorded. How the amount is estimated and recorded, that is the key differences that we discussed here. In the IFRS, it will be the record best estimate, but when it comes to US GAAP, it will record the minimum amount. So in the contingent liabilities, the key difference between how the amount is estimated and recorded. Then let's move into financial statement presentation. Both frameworks require companies to present balance sheet, income statement, cash flow statement, statement of changes in equity, and notes to financial statements. However, presentation requirement differ slightly. Balance sheet classification. In IFRS, the format is little flexible compared to US GAAP. US GAAP format is more structured, and when it comes to IFRS, the format is little flexible compared to US GAAP. IFRS allows greater flexibility in how items are presented. It will allow more flexibility or greater flexibility to how items are presented than US GAAP. Then the extraordinary items. In IFRS, there is no extraordinary items are permitted, and in the US GAAP, rarely it is allowed, and mostly it is eliminated also. In most cases, mostly it is, in IFRS, it is not permitted, but in the US GAAP, it is rarely and mostly eliminated. Rarely allowed and mostly eliminated. Then the disclosure requirement. Financial statement must include note and explaining accounting policies and significant transaction in both US GAAP and IFRS. The typical disclosure include accounting policies, contingent liabilities, lease obligations, revenue recognition policies, and risk exposure. All these should be disclosed as notes to financial statement. Although disclosure principles are similar, but in IFRS often required more narrative explanation, while the US GAAP provide more specific guidance. In IFRS, it is required more narrative explanation of the transaction, while the US GAAP provide more specific guidance on financial transactions. So this is a quick comparison summary of how the different financial topics are treated in IFRS and US GAAP. The revenue recognition, it is 5 model in IFRS and 5 model in US GAAP as well. Lease accounting, it's a single model in IFRS, and US GAAP allow operating and financing models. Balance sheet format is more flexible in IFRS and which is more structured in US GAAP. Extraordinary items, it is not allowed in IFRS and rarely used in US GAAP. So let's move into practical questions, multiple choice question. Question 1. Both IFRS and US GAAP recognize revenue when? First option, cash is received. Second option, contract is signed. Third option, control of goods or service transferred to customer. And fourth option, production is completed. It is option C. Revenue is recognized when control transfer to customer according to 5-step revenue recognition model. So here the option C is the right answer. And question 2. Under IFRS, potential liabilities are commonly referred as deferred obligations, provisions, operating liabilities, and contract liabilities. It is provisions. In the IFRS, potential liabilities are commonly termed as provisions. Question 3. Which statement regarding to lease accounting is correct? Both IFRS and US GAAP require lease to remain off balance sheet. IFRS uses a single lease accounting model. GAAP does not recognize lease liabilities. IFRS does not recognize right of use asset. Correct answer is IFRS uses single lease accounting model, that is financing leases only, operating leases not normally using in IFRS, while US GAAP use operating and financing lease classification. Before winding up this discussion, just a quick summary what we discussed today. It is the key differences between the IFRS and US GAAP. The both framework recognize revenue based on the 5-step model recognition, that is similar in both IFRS and US GAAP. IFRS uses single lease accounting model, while US GAAP uses 2 classification, that is operating and financing leases. IFRS refers to uncertain liabilities as provision. Uncertain liabilities in IFRS called as provision. GAAP generally uses higher probability threshold for liability recognition. And IFRS allows more flexibility in financial statement presentation than US GAAP. This is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.